Hello and welcome to a CMS Forex daily video recap. I'm your fundamental market analyst, Nick Nassad. Today is Tuesday, June 22nd, 2010. The hype and optimism over possible rise in the Chinese yuan continued to fade in today's trading following what we had seen in late New York trading yesterday. And also, we had some concerns about the health of the European financial sector, which pressured the euro-dollar pair and had the euro falling to the 1.2250 level before it found support in New York trading. China's central bank appeared to be trying to temper expectations that the Chinese currency is bound to rise, conveying the message that currency policy reform doesn't mean one-way bets are a sure thing, and the Chinese yuan actually fell against the dollar in today's trading. That led to some uncertainty, and investors filed out of assets considered riskier overnight, which benefited the dollar and yen. There was also some follow-through to the news that Fitch downgraded French banking giant BNP, opening up fresh worries over Eurozone sovereign debt crisis and possible funding problems for European banks. Following our slide overnight, we tested this 200-period moving average around the 1.2250 area, and as US stocks gyrated in today's trading, first opening higher but then falling into negative territory, but then rallying yet again prior to noon, it gave the euro a chance to pair some of its earlier losses. Taking a look at this pair in a little bit more context, we did have our 2-week rally, that upward sloping trend line of the channel broken in yesterday's trading, so correction is due, and currently we've moved about 38.2% of this full swing up, so it's still to be determined whether we will continue to decline with, let's say, the 50% area, which was our low back here on last Tuesday around 1.2170 as the next level if we continue to move downward, while today's high around 1.2350 would be our next level of resistance if the pair were to continue rallying. If we take a look at the euro-yen pair, we have a similar setup in that we broke our upward sloping level of support yesterday and then moved below our horizontal levels of support around 112, but also the lows from most of last week, not counting Tuesday, at the 111.70 level. So we actually are moving back up to test that old support level as resistance currently. The move below this 115.70 level took us out of this sideways consolidation area, though like I said, we did not actually break below the lows from last week, and currently we have retraced about 38.2% of the full upswing here as well. Now, a further move into the yen would mean increased risk aversion as a result of perhaps the funding problems that could be expected from European banks if we see further downgrades from credit rating agencies. To take that point a little further, we saw the euro-Swiss franc continue to push into new record lows as we hit an intraday low of 1.3585 in today's trading, and this too signals that those concerned about the European financial system are moving into the safe haven of the Swiss franc. Now, the SNB earlier last week had said that it would stop intervening in the markets, so it would let the Swiss franc appreciate against the euro, and right now markets are testing the validity of that statement. So the declines seem a little bit sharper against the Swiss franc and the yen compared to the greenback so far. Now, overnight we did have a better than expected report from the IFO, the German Business Climate Index for the month of June, which measures industry and trade, and it showed a slight improvement to 101.8 from the May reading of 101.5. Current conditions improved while the expectations for the next 6 months dipped slightly. Still, overall, the report shows that the economic recovery in Germany continues, with manufacturing and wholesalers feeling better than retailers. Steady demand for German exports was offsetting businesses' fears over the impact of 80 billion euros worth in budget cuts proposed by German Chancellor Angela Merkel. Turning to the pound-dollar pair, we saw it fall overnight and in early New York trading as we had risk aversion. But then the pound rallied during the rest of the session following the unveiling of the new budget for the UK. The new budget said that it would cut a total of 40 billion pounds a year by 2015 from the deficit, which would eliminate the country's structural deficit. That is, the spending that the government does without cyclical factors. The new Chancellor of the Exchequer, George Osborne, said that total borrowing would fall from £149 billion this year to £37 billion in fiscal year 2015, and that borrowing as a percentage of GDP would drop to 1.1% over that period. that would assure the country keeps its AAA rating, and markets responded warmly to the announcement that the UK government would have to sell less of its gilts. The UK was warned that it would have to step up its budget deficit cuts in order to keep its AAA rating, so this was taken as a positive, and borrowing costs in terms of government bond yields did drop, so it means that the government will be able to borrow at lower interest rates. Still, the fear is that spending cuts by the UK government, as well as the increased taxes, could derail the UK recovery and send the country back into a double-dip recession. Taking a look at the euro-pound pair, we saw the pound gaining strongly against the euro, breaking out of its three-session range here. Taking a look at this pair over the last month or so, we see that we are close to our support here at the 0.82 level. So we'll see if the euro-pound pair extends this move in favor of the pound to continue this week. Now let's switch focus and take a look at some U.S. fundamental reports. First, we had sales of existing homes for the month of May, and it showed a decline of 2.2% to a 5.66 million annual rate. That was much weaker than expected, as forecasts had called for a rise in sales. In order to receive a government incentive worth as much as $8,000, buyers must have signed contracts by the end of April and need to complete those deals by the end of this month. So despite that the expiration of the tax credit has not yet come in terms of actual sales, demand for existing home sales was probably pulled into prior months prior to the June tax credit deadline. What today's data shows is that there is an increased risk that there will be retrenchment in the housing market following the expiration of the tax credit, and that retrenchment will be deeper than anticipated, a negative for U.S. growth. Now, there was some positive from U.S. fundamentals, and that home prices for government-sponsored mortgages rose 0.8% in April, on top of March's revised 0.2% gain. The year-on-year rate was also moving towards break-even at minus 1.5% in April versus minus 2.7% in March. Second-round stimulus, which ended in April, gave a boost to demand and helped to firm prices, but today's existing home sales report is weighing down by heavy supply and raises questions whether home prices can extend their improvement. In a third report, manufacturing activity in the Central Atlantic region expanded for the fifth consecutive month, though the composite index did decline 3 points to 23 from May's reading of 26. Still, this was better than forecasts, and it shows that that region is holding up much better than what we had seen in the Philly Fed manufacturing index. Among the index's components, shipments eased 1 point to 31, new orders dropped 11 points to finish at 25, while the job index picked up 5 points to measure a reading of 9. So as we can see from the chart to the right, activity is still at a rather high level compared to the last 10 years of data. But we'll have to see what the second half of the year will hold, as we have government stimulus waning, as well as the implications of the Eurozone sovereign debt troubles. In a fourth piece of fundamental news, this from Canada, we saw annual inflation slow to 1.4% in May from 1.8% in April. The core rate that excludes 8 volatile items also slowed to 1.8% from 1.9%. While both annual readings were higher than expected, as was the headline monthly rate, the current pace of inflation is not enough to pressure the Bank of Canada to move higher on interest rates if they do not want to and would rather wait and assess the state of the global economy. The upcoming fundamental docket will hold some key reports. Tonight, New Zealand posts its current account, but overnight we get flash manufacturing and services PMIs from Germany as well as the Eurozone. Also overnight, Germany posts a measure of consumer climate, while the UK releases its Bank of England meeting minutes, a measure of mortgage approvals, as well as a measure of retail sales. Tomorrow, first we get a report from Canada on its retail sales, and that will be followed by new home sales from the US, but at 2:15 we get the FOMC interest rate decision and the assessment of the economy by policymakers. So that is sure to create event risk after it comes out. So that will do it for today's video recap. For more news, videos, and analysis, please visit our site, cmsfx.com. I want to thank you for watching and wish you good trading.